In the summer of 1998, Wall Street faced a financial cataclysm so severe that it brought the global economy to the brink. The culprit? Long-term capital management, LTCM, a hedge fund run by the brightest minds in finance, two of whom were Nobel laureates. Armed with advanced mathematical models, they promised to turn risk into reward, predict market fluctuations, and deliver guaranteed profits. But by September, this titan of Wall Street was crawling to the Federal Reserve for a bailout, leaving a $1 trillion crater in the financial world. How could models grounded in the highest echelons of academia fail so catastrophically? If Nobel Prize winners couldn't see the storm coming, what does that say about anyone else's ability to predict financial absolutes? This shocking event raises a critical question. Why do our best financial models, those designed by the smartest individuals, built on seemingly unshakable theories, keep crumbling in the face of uncertainty? Why do they fail just when they're needed most? Today, we're diving deep into the world of financial black swans, exploring how unpredictable events reveal fundamental weaknesses in our financial systems. When financial markets hum along in their usual rhythm, risk models appear to work like clockwork. At the core of these models lies a mathematical tool that many of us have encountered before: the normal distribution. The normal distribution assumes that most market movements will fall in the middle. Small changes in stock prices, bond yields, or currency values. According to the theory, an event that's 6 standard deviations away from the mean, a so-called 6 sigma event, should only happen once every 1.4 million years. Risk managers calculate value at risk, VAR, a metric widely used by financial institutions to estimate potential losses during a single trading day. If a portfolio's daily VAR is $10 million at a 95% confidence interval, the model estimates that 95% of the time, losses shouldn't exceed $10 million. On most days, stock indices like the S&P 500 move incrementally, up a fraction of a percent, down by similarly small margins. Over 100 years, extreme deviations in real-world financial markets have occurred far more frequently than they should have. Real returns on the S&P 500 have deviated 5 standard deviations around 7 times more frequently than models predict. Even in these typical conditions, whispers of their limitations start to surface, a crack in the surface, warning of what's to come. Risk models are built to provide a sense of control, a way to quantify the unpredictable. At first, let's imagine a moderate shock, say, a sudden 5% drop in a major stock index. Enter October 19th, 1987, Black Monday, when the Dow Jones Industrial Average nosedived by 22.6% in just one trading session. According to the Gaussian distribution, this was a 20 sigma event, so astronomically improbable that it effectively couldn't happen. And yet, it did. Portfolio insurance, a strategy meant to hedge risk through dynamic selling of stock index futures, became a key player in the chaos. As markets began to fall, portfolio insurance triggered massive, automatic sell-offs, creating a snowball effect that deepened the crash. Traditional models treat market movements as isolated, random events, predictable within a neat bell curve. But in crises, markets become interconnected in dangerous ways. Markets exhibit emergent behaviors, where small disturbances can lead to massive, system-wide disruptions. During Black Monday, selling overwhelmed markets so thoroughly that liquidity evaporated. The assumption that traders could always get out proved disastrously incorrect. These models fail to predict, or even consider, the domino effects of interconnected systems. As markets grow more complex and interdependent, the hidden weaknesses in these models become harder to ignore. When financial systems unravel, they expose glaring blind spots in the theories and models underpinning them. Every major market crash brings these flaws into sharp focus. Correlation breakdowns, fat tail distributions, and the unpredictable nature of human behavior. In stable markets, correlations between asset classes behave as expected, with stocks and bonds exhibiting an inverse relationship. During the 2008 crisis, asset correlation soared from 40% to 70%, as previously uncorrelated assets began moving in lockstep. Traditional models assume market returns follow a normal distribution, where extreme losses are considered extremely rare. Reality proved different. Extreme events occurred far more frequently than models predicted, with massive market drops happening multiple times in 2008. Markets are not mechanical systems. They're deeply influenced by human emotions, fear, greed, and stress-driven decisions. During the 2008 crisis, panic drove investors to withdraw $200 billion from money market accounts in just days. The crisis revealed how these three blind spots, correlations, fat tails, and human behavior, created a perfect storm of market failure. These blind spots aren't just historical. They continue to shape how models fail in the present, leaving us vulnerable to future crises. In the wake of repeated market failures, one concept has gained traction for its ability to transcend traditional risk models: antifragility. Coined by Nassim Nicholas Taleb, antifragility describes systems that don't just endure shocks, they actually thrive and improve because of them. Unlike standard risk models that aim to avoid or minimize volatility, antifragile systems embrace uncertainty and leverage it as a source of growth. Traditional systems are too reliant on static assumptions, correlations that won't hold in crises, bell curves that don't reflect reality, and human behavior reduced to numbers. The barbell strategy commits a significant portion of resources to ultra-safe assets, while dedicating a smaller portion to high-risk, high-reward ventures. JP Morgan maintained a conservative risk posture during the 2008 financial crisis, avoiding excessive exposure to subprime loans and retaining higher capital buffers. Singapore's sovereign wealth funds hold enormous cash reserves and hedge against extreme scenarios, allowing them to take advantage of undervalued assets during downturns. Build your own barbell strategy by dividing resources between low-risk assets and high-risk investments that could thrive in a fractured world. The key is to stop pretending we can predict the future and start preparing to thrive in its chaos. After all, the next Black Swan isn't a question of if, it's when. As much as we'd like to believe we've learned from past financial crises, the harsh truth is that future Black Swans remain as unknowable as ever. Their very definition, a highly improbable event with massive consequences, makes them notoriously difficult to predict. Over $21 trillion in government debt has been purchased by central banks since the 2008 crisis, creating potential for sovereign debt and currency crises. Climate change is unlike anything markets have faced before, with potential for catastrophic environmental events to upend supply chains. In a world increasingly reliant on digital infrastructure, a coordinated cyber attack on global financial systems could wreak havoc. Watch for unusual synchronized movements in unrelated asset classes. If bonds, equities, and commodities move in tandem, it could signal systemic instability. Diversify beyond traditional assets. Explore real estate, commodities, cryptocurrencies, and entrepreneurial ventures. You cannot predict what you cannot imagine. But preparing isn't futile, far from it. The goal isn't bulletproof certainty, it's adaptability and resilience. For all the allure of mathematical models and the promise of perfect predictions, the inescapable truth is this: no model can fully encapsulate the chaos and unpredictability of financial markets. From the shocking failure of long-term capital management to the widespread panic of the 2008 financial crisis, we've seen how models crumble under the weight of extreme events. Systems built on overconfidence, on the assumption that the worst is behind us, or that probabilities are invincible, are doomed to fail. Financial planning requires acknowledging not just what you know, but what you don't know. Recognize that models are just tools, not crystal balls. Let's boil it down into actionable takeaways for building financial resilience. Cash reserves aren't just defensive. They're opportunities waiting for the right moments. Are we ready, not just for the crises we imagine, but for the ones we cannot see coming? True resilience lies not in avoiding risk, but in our ability to adapt, endure, and evolve beyond it.